Good morning, students. Welcome to online session of accountancy. Till previous class, we have studied about first chapter of accountancy, that is Introduction to Accounting. With the help of that chapter, we got to know that accounting is a systematic process of identifying, measuring, recording, classifying, summarizing, interpreting, and communicating financial information to the users. After that, we have seen many characteristics, objectives, and functions of accounting. There were advantages and limitations that we have discussed. After that, role of accounting in business we have seen. Accounting process we have discussed. Accounting process means that is first financial transaction and events will be identified, then it will be recorded. After that, it will be classified in a manner of posting in ledger, then summarizing, analyzing, and communicating. After that, there were three similar terms, that bookkeeping, accounting, and accountancy, that we have studied, that all three are different words, different terms. Then there were some qualitative characteristics of accounting information that we have seen, and systems of accounting we have studied. There are two types of systems of accounting. First system is double entry system and another is single entry system. Now today onwards we will have the chapter explanation of chapter 2. As you can see here, many accounting terms are given here. All these accounting terms are just prescribed in our syllabus. So all these terms we are going to study in this chapter number 2. As this accountancy subject is new for you all, here it is very necessary that you can understand each and every accounting terms very clearly, because when you will understand the term, after that you will understand the meaning of that practical questions or the theory part of this accountancy. So first of all, as in business, various accounting terms will be used. So it is necessary to understand all that standard accounting terminology so that you can understand the accounting process. Terminology means that is a special word that are used in a particular profession or subject. First term that is given here is the business transaction. Now the term business transaction means a financial transaction or economic event. Now meaning of financial transaction or economic event is that should be connected with supply of money, business or industry. Now in this transaction at least two parties are needed, and that should initiate. Initiate means they should start. They should start the accounting process of recording it in the books of an enterprise. Now this financial event or economic event, that should be expressed in terms of money. That should be measured in terms of money. Now, and this financial transaction, it will definitely bring a change in the financial position of an enterprise. Financial position means that state that assets and liabilities of that particular firm. In simple words, we can say that business transaction is a kind of agreement between the two parties that is involving there. Why they are involving, in which process they are involving? They are involved here for the transfer or exchange of goods or services. Now understand with the help of few example here. First example that is given here is sales of good. Now when that sales of good is will be there, the firm, it will be the first party or one party that is considered as the seller, and another party that will be considered purchasers. So two parties are involved here. Take next example, that is purchases of goods. Here firm is purchasing something. One party is firm here and other party who is selling their goods, that will be considered as second party. Again two parties are involved here. So in this manner, in receipt from debtors, payment to creditors, purchase or sale of fixed assets, payment of interest, payment of dividend, etc. will come. Now, meaning of dividend is it is a part of share, that is profit of share, that is paid to shareholders. Now down we are having some characteristics of a business transaction. First of all, that business transaction should be concerned with money or money's worth of goods and services. Means whichever transaction is there, that can be measured in terms of money, or they should have some value. Second is it arises out of transfer of or exchange of goods or services. Means wherever there is transfer of goods or transfer of that services, that time this business transaction will arise. Third is it brings about the change in the financial position. As I have explained earlier, that will a business transaction will give a change in the financial position of a business. Financial position means in assets and liability. Now this business transaction, they may affect in a manner of increase or decrease in the value of assets and liability. Fourth is it has an effect on the accounting equation of any business firm. Accounting equation is a mathematical expression which shows that the assets and liability of a firm are equal. So that accounting equation is there, that is assets is equal to liabilities plus capital. So every business transaction will affect this accounting equation. Fifth is as it is dual aspect, so two sides will be there. One side will be considered as receiving or debit, another is giving or credit. Now in simple word we can say when that firm they are receiving the benefit, that will be recorded on one side, and when that other is giving benefit, that giving the benefit to others, that time it will be recorded in another side. Sixth is after each transaction the total asset of a business must be equal to its liability of and capital. Therefore the equality of the business cannot be disturbed by any transaction. As I have explained that accounting equation, what was that accounting equation? Assets equal to liabilities plus capital. So each and every transaction that will definitely affect the accounting equation, but it should not disturb the balance, equality of balance sheet. What is that equality? That always assets will be is equal to capital and liability. 7. The nature of each transaction is carefully analyzed since it affects the financial status of a business unit. Whenever this business transaction will be there, its nature will be analyzed very carefully. Whether the transaction is belonging to that external party or internal party. For this we can see this diagram. This diagram is very helpful to understand the business transaction. As here business transaction will be there, this we have to identify. What two things we have to identify? First, that its relationship with the accounting units. There are two kinds of units, internal and external. So we have to identify the units first. Internal transaction or accounting transaction. It means that when no any another or second party is involved there, that time that particular transaction will be considered as internal transaction. External transaction, when that between a business entity and a second party will be involved there, that will be external transaction. For example, for internal transaction, depreciation on fixed assets, for internal depreciation on fixed assets, and for external that when that creditors will be involved or bills payable will be there, that will be under external transaction. Second is to identify the mode of settlement of value. There are two modes of settlements, cash or credit. When that the amount is transacted or paid or received immediately on entering into a transaction. That time it is called cash transaction. When it is promised to pay later and not given at the same time immediately there itself, that time that transaction will be considered as credit transaction. Next is account. Now it is a record, that account is a record of transaction under a particular head of account. It can be any salary account, telephone expenses account, then electricity expenses, or it can be for a particular head. It can be for assets or liability. For when we will say assets account, various assets are there like cash, machinery, building, vehicle. Under all this, accounts can be maintained. And for liability, we are having creditors, capital, bills payable, like this. So when that transaction will be recorded under particular head of account, that time this accounts will be maintained. Now it is not only that we are recording all this transaction in account. This accounts also shows the amount of transaction, whether how they are affecting and in which direction they are affecting it. Whether that account because of the transaction the amount is increasing or decreasing, that will be also ascertained there. Third is capital. The capital, that is a kind of amount that is invested in the firm by proprietor if it is proprietorship firm, or if by the partners if it is partnership business. Now if it is any company, then the contributor of capital will be shareholders. Now this capital, they are in the form of money and assets also. Now when we are talking about asset, so that asset should have any monetary value that can be measured in terms of money. Now this capital has been considered as a liability of the business towards the proprietor or partners. By if that the businessman they want to discontinue the business, that time first of all this capital will be returned to this proprietor, that owner or partner. Now this capital, it increases and decreases, both effects are there. Now we'll see when it will be decreased and when it will be increased. Suppose any business they have done some investments. So from that investment they will earn some profit, and from the business itself they will earn some profit. So this profit they will increase the capital of the firm. Now when there are drawings, means that proprietor or partners, when they are drawing some amount from the firm, that time this capital amount will be decreased. And at the time of loss, if that business they have incurred the loss, that time the amount of this capital will be decreased. Now capital has been considered as the liability, that is under one concept. That concept is business entity concept. Now according to this, business is a separate and distinct entity from its owner. Now when that owner, when they have introduced that capital to the business, his account will be kept separate, and each and every account will be maintained from the point of view of business only. The capital is also known as owner's equity or net worth. Now this is always equal to assets minus liability. Down we are having one equation here. Capital is equal to assets minus liability. Next is drawings. Now drawing is that amount that is withdrawn by the proprietor or partner for personal use. Now this drawing can be in manner of goods also. When good is taken out by the proprietor or the partner, that time that particular goods will be valued at purchase cost, not the selling cost. Now this drawing, this will decrease the capital of the owner. That is why by this drawing the proprietor or that partner, they will that will be debited to the drawing accounts, and at the time of preparation of balance sheet, this drawing will be deducted from the capital of the proprietor or partners. Next is liabilities. Now liability means that amount owned. Owned means that is payable by the business. Now these liabilities are of two kinds.